Everybody to the Knowledge Circle on June 15th, 2021. It's my pleasure to once again have Marvin Blum from the Blum Firm out of Fort Worth, Texas on the show. For those of you that listen to us regularly, we had Marvin on just after the November election last year, talking about a lot of what was possibly going to be going on with the potential change in control of from Republicans to Democrats, White House, and we didn't know Senate at that time. And so if you wanted to see it, there is a replay of the prior show. But what Marvin and we wanted to do was have a really good conversation on the potential law changes this year, talking about what is on the hopper, what looks like it could pass. If it does pass, will it be retroactive? Will it be next year? The one caveat is no one knows exactly for sure what's going on. So I have other advisors in my office. I run a team at Avidian Wealth, and they're saying, Scott, you're talking and writing so much about this, but no one knows what's going to happen. But for us as CFPs and financial advisors, where our clients count on our guidance in terms of where we see clients going, and when we're working with teams of attorneys and CPAs and appraisers and business brokers for our clients, it behooves us to stay on top of these things. So Marvin and I have been chatting over the last few weeks, and we came back with several areas where we wanted to give you Marvin's current thoughts on these areas. We'll go through what the potential changes are and also what we think has the highest likelihood of passing. We were actually talking via email and on the phone right before this call. So Marvin, I just want to confirm first off before we get started that you can hear me all right?
I hear you great. Yeah, I hope you hear me too.
Okay, great. So Marvin and I are friends. He has a small office in Houston where I'm located, but his main offices are in the Dallas-Fort Worth area in Austin. So for those of you listening in Texas, I would definitely recommend that you check out the Blum Firm and talk with Marvin. I love the people on his team. He has a nice, large, and deep bench on his firm. But Marvin, what I really wanted to go, since you are an attorney and a CPA, I wanted to start talking about, since we had our last conversation right after the election, maybe you can go through some of the key developments that are impacting your thought process on what may be changing going forward.
Well, yeah, what a year since we last came together, Scott. And we're all sitting on the edge of our chairs waiting daily for updates on all of this. When I was with you on November 5th, was 2 days after the election, it was pretty evident that Biden had won, and most betting people would have predicted that the Republicans had retained control of the Senate. But lo and behold, the biggest development since then happened on January 5th, when we had the two runoffs for the Georgia Senate seats, and they both ended up going to Democrats. That tilted the balance of power in the Senate from R to D. We ended up with 50 Democratic senators with Kamala Harris as tiebreaker. And that then gave carte blanche to Democrats to kind of make whatever happen that they want to see happen this year. And that changed everything. The first piece of legislation then that came out of this new Congress was March 11th. And you'll recall there was what we called the American Rescue Plan, but it was a COVID stimulus package, the one where the government sent out a bunch of big checks. I heard a commentator recently call that bill, and he described it as all candy, no spinach. And I love that metaphor, because truly that bill of 1.9 trillion of all spending without worrying at all how to pay for it. But now we're moving into the spinach phase. And so
some candy too, I would think. Candy and spinach.
Yeah, and candy and spinach. There's more candy. Yeah. And now we have to deal with some spinach along with the candy. But as you all know, Biden has an agenda. He Build Back Better agenda. And he's developed an American Families Plan that has two parts to it. The first part is 2.3 trillion. These numbers are so astronomical, you can't even wrap your head around it. But 2.3 trillion, that's called the American Jobs Plan. That piece is for traditional infrastructure. It's mostly roads and bridges, okay? Then the second piece of this is 1.8 trillion. It's part of the Made in America tax plan, but that is for social infrastructure. He's calling that infrastructure too, but this is really childcare and anti-poverty. I wouldn't have called that infrastructure, but they're using the word infrastructure because that helps sell it. But if you add all this up, we had 1.9 trillion was passed in March. He wants another 2.3 trillion for roads and bridges. He wants another 1.8 trillion for social infrastructure. Tallying all that up, I get to 6 trillion. That's a lot of spending. That's a lot of candy. And that's more spending than this government has perhaps done ever. And, it harkens back to, FDR and the New Deal and all.
Or at least LBJ.
LBJ.
Yeah.
LBJ, and those are the comparisons. You hear the comparisons to LBJ and you hear the comparison to FDR. And I think that's the legacy that Biden is trying to create here. So that's $6 trillion of candy.
And a $6 trillion Green Book budget.
Oh, yeah.
Well above and beyond what we typically would have for a budget, where it's usually $2.5 to $3.5 trillion for the traditional annual fiscal budget.
Exactly. And so anyway, I appreciate the chance to kind of dive into all this with you now.
Okay, that sounds great. So the next section, what I wanted to go into is some of the stuff that deals with the income tax side and some of the stuff that deals with some of the things that would change both from the income tax, estate tax, and the business planning. We have a few of the plans, so maybe you could talk about some of the other acts that's being proposed in Congress that were not specifically being proposed by Biden, although I believe he supports them.
You bet. The first one that was introduced in March, it was introduced March 25th. That's by Senator Bernie Sanders. And that piece of legislation is called For the 99.5% Act. Now, there's a lot of gamesmanship in this stuff on how you name these acts. I mean, it's very, very intentional naming here. But the concept that Bernie Sanders is going after in calling this For the 99.5% Act is that he's commenting on the fact that he believes that these tax increases that he's calling for will only impact 0.5% of the population. And that therefore he's trying to drum up public sentiment of the masses to support this, because 99.5% of America is supposedly not affected by it. So that's that's For the 99.5% Act. We'll talk more about that one. But then 4 days later, there was a second act introduced in the Senate. It's called the STEP Act, STEP. And you're going to see it has a whole lot to do with stepped up basis, and that's why the term STEP. But that got introduced by Senator Chris Van Hollen of Maryland, along with some other senators, including Bernie Sanders and Elizabeth Warren. So those pieces of legislation are out there now being debated.
So that kind of gives us the backdrop of the fiscal plan, a backdrop of the stuff that they're talking about. And like you and I talked about before, I think some of the things that we thought may have been big priorities a few months ago have changed. So maybe you can kind of break down some of the key provisions now that you've named the legislation.
Let me start with Biden's administration and what he's advocating here, and his Made in America tax plan. As you pointed out, his Green Book recently came out. It came out on May 28th, and it's 114 pages long. It's his wish list of tax changes. But included in that is first of all, to increase the corporate income tax rate. Now, remember, before Trump, the corporate tax rate was 35%, the top rate. That was reduced in Trump's Tax Act to 21. Biden's proposal is to up it back up to 28. Okay, so we would be going from 21 to 28. Another provision in here affects corporations, and this one is a 15% corporate minimum tax on the book income of large global corporations like Amazon and Nike, who essentially pay no U.S. corporate income tax because of the use of foreign tax havens.
And they talked about that in the G7 meetings over the weekend as well.
Yeah, exactly. They're trying to get the countries around the world to have a minimum rate of income tax on corporations to keep people from going offshore to save tax. Mm-hmm. Now, Biden is also very, very big advocate of increasing the capital gain tax rate. He's become sort of the biggest champion for this of anybody. I don't know that we all saw that coming, but it has really become. I think he's going to fight very hard for this, You know, his politics are coming through on this one. And again, I'm not taking political stances. And one of the comments in the chat was saying, you know, don't get into politics. And trust me, I'm not, because you won't know at the end of the day who I voted for and why, because I'm not going to reveal anything about my personal politics here. But I will just tell you the facts there that Biden is coming out left of center on his tax proposals here. He's closer to Bernie Sanders on this than he is to Joe Manchin. And he's advocating for an increase in the capital gain rate from 20% plus the 3.8% Obamacare tax. You know, right now the top rate is 23.8. He's advocating to basically take it all the way up to almost double it, to take it up to 39.6% capital gain rate plus 3.8 Obamacare rate. So you're looking at 43.4 capital gain. And if you're in Texas, that's all you pay. But if you're in a state with a state income tax, you're paying the state capital gain tax rate on top of that. You know, you could be paying another 15% on top of the 43. So, so the Biden is really pushing hard for this. And that has to apply to people whose incomes are over $1 million. He stresses over and over again that he doesn't want to do anything that affects the tax situation for somebody who is making $400,000 or less. But if you're over $1 million income, he wants your capital gain rate, long-term capital gain rate, to go up to 43.4.
Well, one of the things I'm seeing is we do have some people who could have been maybe blue collar workers to some extent, been a plumber, they have a plumbing business, and now as a baby boomer wants to sell the business, you could have a one-time event that pushes you past that threshold where you weren't necessarily the people in the bullseye that were done. I know on the estate tax side, they've talked about making exceptions for small businesses and family farms and stuff like that. I haven't seen any exceptions being thought of for the capital gains tax for those one-off capital events.
There are no exceptions on that. You're exactly right, Scott. But let's shift over to the estate tax side, because there's a lot to talk about there. In the Bernie Sanders bill, for the 99.5% Act, I'm going to give you just a quick overview of what that is advocating. First is the estate tax exemption. The current estate tax exemption is $11.7 million. So for a married couple, each husband and wife each get 11.7. That's $23.4 million that a couple can have without being exposed to federal estate tax. It has never been anywhere close to that. I mean,
it's the highest in my career. I started at 600,000 in 1997.
Exactly. Yeah. Well, Bernie Sanders wants to reduce the 11.7 down to 3.5. And frankly, that is a position that Biden is in favor of as well. Now, that's the estate tax exemption. But let me talk about another thing you don't hear much about. It's the gift tax exemption. How much can you give away during lifetime without paying gift tax? Currently, that's 11.7 million. Under the Bernie Sanders bill, that goes down to 1 million. The drop from 11.7 down to 1, that's a humongous drop.
Okay? And that's de-unifying the unified credit that got reunified not that long ago.
It won't be called unified anymore, right?
Yeah.
And the other thing he wants to do is when you do hit the place where you're paying estate tax or a gift tax, the rate is not 40 anymore. It goes up to 45%, and it goes on up from there. If your net worth above 10 million, the rate's 50%. Then it goes on. If over $1 billion, it's at 65%. Listen, lots of stuff in here. Annual exclusions. We are all familiar with the opportunity to give $15,000 to as many people as you wish each year. Well, he proposes to cut that 15,000 down to 10, but even more importantly, he wants to put a cap of $20,000 per donor per year on any gifts you're making to trusts or any transfers of interests in entities. So most of us, like you're funding an ILIT, an irrevocable life insurance trust, you'd be capped on the ability to only put $20,000 a year into that ILIT. And above that, then you'd have to eat into your lifetime exemption. Valuation discounts, which is one of my favorite friends in the estate planning community. You know, we love the opportunity to do squeeze planning, where we transfer assets into a family limited partnership and then make transfers of the FLP units. We hire an appraiser and we get a report that gives us a valuation discount, lack of control, lack of marketability. And we've been taking haircuts off of the values now for over 30 years and being very, very successful with it. Well, he wants to kill that. No more valuation discounts the way we've been doing them. Grants are going to be drastically different. The grantor retained annuity trust for people who love the grat. It won't look anything like it used to look. You can't do a short-term grat anymore. They have to be 10 years or longer. And if you die within the 10 years, the whole thing fails. And you can't do a zeroed out grat. You can't set it up where the gift is zero. It would have to have a gift of at least 25% of the amount you've transferred, or if greater, 500,000. So there's a lot of changes. But I tell you, the one thing that the dagger in my heart the most is the provision related to grantor trust.
And that's a big one that not everyone may understand. Go through that one a little bit slowly, because I don't know if everyone on the call will understand how much that will impact intra-family gifting.
Huge. It's huge because when you go visit with an estate planning lawyer today, almost every estate planning lawyer is going to describe to you a technique to help you lock in the exemption at the current level and shift the appreciation out of your estate. And the way they're going to do this, by and large, is going to be through you creating a grantor trust and shifting your assets into this grantor trust. There's a whole bunch of different kinds. The most popular is called a DIGIT, or a defective grantor trust, sometimes called intentionally defective grantor trust, an IDIGIT or an IDGIT. You may have heard of this. Very, very popular. The other kind that is actually grantor trust is a SLAT, a spousal lifetime access trust. That's a grantor trust too. You want to know another grantor trust? An ILET. Almost all ILETs are grantor trusts. People don't understand this. They gloss over this thing. It's huge. The new rule says if your assets are in a grantor trust, to the extent you added any assets to a grantor trust after the date of passage of this law, those assets plus whatever they've grown to by the time of your death would be included in your estate. So let's take an ILET. You've got an old ILET and you're funding it every year with the money to pay the premiums. After this date of passage, from that date forward, you're going to keep score. How much did you put into the ILET after the date of passage? You're going to add that up and compare it to what you put into the ILET before the date of passage. You're going to get a percentage. And the percentage you put in after the date of passage, that percentage of the life insurance proceeds will be taxed in the insured's estate. People don't even talk about that. I see almost nothing about that, but that's the effect of what we're looking at here. So we've got to get clever here. We've got to draft our ILETs to not be grantor trust. We've got to figure out how to do that.
And gain recognition events where you should be able to put the asset in with low basis. And again, that would have the downside for a trust. If you were gifting, not maybe with a partnership, but through a trust, or even funding a partnership, that was a non-taxable event. And I don't even know how this is going to impact businesses. That's a whole separate question.
Oh, yeah.
But it's going to be, that's a taxable event, and it's going to be very, very hard to use.
Yeah, I'm going to go there. But before I do, I will point out Bernie Sanders, this is a huge deal. The bill says that any planning you completed before the date of passage is grandfathered.
Yep.
Hence the rush to do the work now, to plan now, because if you get your planning done before the bill passes, you're protected. You're under the old law. There is no clawback. And it says in Bernie's bill and in the Green Book, you're going to be grandfathered. So that's the big, big deal there. Let's talk about this other, the STEP Act.
Real quick, while we're on this, so if a client came to you with a $30 million estate right now, and they were unsure of what's going to happen, what would be the structures you intend to tell them to put in place to make sure they beat this law? I mean, whether it be this, just go through the list.
Here's what I would do with a $30 million client right now. I would say, let's break this into steps. First step is let's transfer your assets into a family limited partnership. And I'm going to hire an appraiser who's going to tell me what your FLP units are worth. And the appraiser is going to look at that and say, oh, you've got 30 million of assets in there, but I'm going to appraise your partnership interest as if it's worth, say, 20 million, 22 million. Okay. That's going to be my fair market value of the FLP units. 30 days after you fund that FLP, I'm going to recommend that you create, if they're a married couple, I'm going to recommend that the husband and wife each create a SLAT, a spousal lifetime access trust. So husband creates a trust for the benefit of wife. Wife creates a trust for the benefit of husband. And we're going to partition those FLP units so they're owned half by the husband, half by the wife. Husband's going to make a gift of his units to wife's slat. Wife's going to make a gift of her units to husband. At the end of the day, here's what you've got. End of the day, you have a slat for the benefit of husband that owns half of the FLP, and you've got a slat for the benefit of the wife that owns half of the FLP. They file gift tax returns. They file gifts showing that they have used up, say, 22 million of their lifetime exemption, that they had 23.4. They pay zero gift tax. The estate, the assets are now completely out of their estate, and they're home free. And now all the growth can happen in the slats. And for the rest of their lives, they live off of the slats. They have control and access. They can change who it goes to upon their death. They can have a special power of appointment in there. Importantly, no matter how big those slats get, they're out of the estate. That's what I would do with a $30 million client.
And then if there's some people that want to also bring the kids in, maybe you could talk about the timing of where you do the idiots for the kids, maybe also, or maybe even some islets, just so at least we have those trusts in existence before any passage of legislation.
Yeah, and I see a question here about which proposed law would change the treatment of grants, and that's for the 99.5% Act.
Yes,
that's in the Bernie Sanders bill. So that's a big deal. But there is this other act that's called the STEP Act, and I want to turn to that one now, because that one is actually getting more attention than any of this, because this is the one that kills stepped up basis.
That's where the money is really.
My God, that's where the money is. The money is not in the estate tax.
No,
that's more social engineering. But the money is in this, and this is the deal where, like, I bought a stock and I paid, $100 a share, and then by the time I died, it was worth 150 a share. I passed the stock on to my family with a basis now of 150. You get to erase the gain that was inherent in the stock on the date I died. Well, that would go away under this STEP Act. It says it's retroactive to January 1, 2021.
That's written, not as passed, of course, but as written.
As written.
Yeah.
That's how that's worded. And the thing that is shocking to me about it is it doesn't replace it with what I call carryover basis. It doesn't just say that when I die, I pass the stock down to my family and they take it now with a basis of 100. What it says is when I die, my final income tax return has to report as if I sold that stock on the date of my death and pay the capital gain tax on it on the date of my death. And so it's a recognition event caused by my death. So you would end up paying capital gain tax on your final 1040.
And that's even if you're below, that could be if you're below the estate tax threshold.
Has nothing to do, nothing to do with the estate. And no matter how big the estate, there's a $1 million exemption. But if the gains are above $1 million, you're paying the income tax on those gains. And furthermore, if you want to give those assets away during your life, you want to make gifts of those assets to some of these trusts that we love, that's another recognition event. The act of making a gift, and you brought this up earlier, the act of making a gift would trigger an income tax on the capital gain. And so that's huge. Now, listen, I mentioned earlier, Biden is a big advocate for raising the capital gain rate. He never advocates raising the capital gain tax rate without also advocating killing stepped up basis. And the reason is they go hand in hand. He's coupling them together. He's treating it like it's a package. And because the belief is if you only raise the capital gain rate, but you leave in place stepped up basis, the belief is the government will lose money, that people will stop selling their assets and say, I'll just hold them until I die and then get a stepped up basis. So to avoid that, holding them till I die, they have to couple this with killing stepped up basis and imposing this realization or recognition event upon death. So that
real quick, I want to answer this. If people want to take a look at this, you made a very specific point, but it was actually studied by the Wharton School at the University of Pennsylvania. If you just did the higher capital gains rates, they did a study that although it may be a little bit of social engineering, it would actually reduce the revenue because of people not having transactions, or at minimum defer it. Because even if they are going to lose it at death, how many people are going to sell a stock that's paying them a dividend to accelerate capital gains if they're significantly wealthy people? They also showed that a lot of very wealthy people like Warren Buffett, Bill Gates, and Bezos, they're getting lines of credit against their portfolios so they can buy whatever they want without having to sell stock. So for those of you that work with firms where you can give asset-based lines of credit, that's what the super rich are doing to avoid paying taxes. So one thing you don't want to do is create these things to be able to generate revenue and then have it actually reduce less revenue like that Penn Wharton study showed.
Well, and that comment you made, there was an article just this last few days ago about that point. They commented, it was, I think, either in the Wall Street, I think it was Wall Street Journal, New York
and
Times.
CNBC had one also. I saw both.
Yeah, and they mentioned Jeff Bezos, they mentioned Warren Buffett, they mentioned Elon Musk.
For sure, yeah.
And there is this, see, there's this is what's happening. They're drumming up public sentiment to kill stepped up basis. They're making this case to the public that this is the greatest inequity in the tax law right now. The opportunity for rich people to grow their estates, not sell assets, and therefore pay no income tax on their increased wealth, borrow money and live lavishly off of the borrowed funds, and then die and get a stepped up basis and erase the gain on that asset.
That helps business, but not the closely held family business.
Right. But see, they're all being lumped together here. You get, what kills, they're killing, they're taking a fire hose, but they're killing it all. Now, and I want to tell you, there's one other crazy thing about this Step Act that you wouldn't believe is in there. But if you have assets in a trust, every 21 years, they're going to treat it like those assets got sold. And you have to write a check for for capital gain tax for any inherent gain that for the assets that are in that trust. You do that every 21 years. So that's a novel idea.
And they're saying that's not that far-fetched. They do it in Canada right now, which is something I didn't even realize until I read an article, I think in Financial Planning magazine, about that.
Yeah, and at one point we would have thought, like you said, we would have thought of that as being far-fetched, but what they're doing is they're building public sentiment to support these concepts, and there is an appetite now that's growing for that to be an acceptable approach. So I tell you, we're going to see some interesting stuff passing. I don't know what's going to pass, but something is going to pass here. And as I said, President Biden is going to be fighting for it, and he's going to get his way on some of this stuff.
I think there's going to be something that's passed this year. But so we've talked about a fair amount of things. We've talked about estate tax exemption. We've talked about estate tax rates. We've talked about tools going away. We've talked about the possibility of changes in income tax on capital gains. One thing I'm for sure seeing is starting last year, I saw a lot of business owners that have been actively, my clients at least, baby boomer business owners are actively either working on or in process of marketing their businesses for sale, because with all this work they put in for 20, 30 or more years, they don't want to have to pay this extra taxes. So for me as a financial advisor, it's been a boon. I said these tax law changes will not help my bottom line from an income tax standpoint, but it's for sure helping my top line, because my revenue this year so far has been off the charts versus a very good year last year too. But of these things that are being talked about, what do you think is likely to pass? What are the most important provisions you think are going to pass?
Yeah, I'm going to take out my crystal ball now. Okay.
Yeah, that's what I wanted. That's what I wanted.
And you all have to understand that this is Marvin's crystal ball. Okay. You can't go to the bank on that. Let's talk about what's likely to pass. And to understand this, let's frame this up. The easiest way to get this legislation passed is if they could come up with 60 senators who would vote for it. Then you get around filibuster. That's hard to get. It's extremely hard to get. But if you can get a bipartisan bill passed with 60 senators, that would be a pretty big dream.
We did with the CARES Act. We got that. Yeah.
We did. But if you can't get that, then the other way you get this passed is what they call the go it alone. Go it alone. That's where it takes all 50 Democrat votes. And I'm saying 50 Democrats. There's a couple of independents that caucus with the Democrats. And so I'm calling this 50 Democrats. Okay. But it's a go it alone approach. Now, look, in reverse, that's exactly what happened when Trump was elected.
Right.
Trump administration had a go it alone Tax Act passed without one without one Democratic vote.
Tax Cuts and Jobs Act. That's right.
Yeah, and so this happened in 2017. So it'd be the flip, go it alone. But I think they're going to make something happen this year. And here's what they've got to make it happen this year, because 2022 is an election year. They don't like to pass tax increases in election years. And the sentiment is that the 2022 election could flip Congress back to being Republican. Either the House or the Senate or both could be flipped to Republican control. Look, there's only an 8-seat majority right now in the House. And as we said, the Senate is 50-50. Yeah. So, any movement in the 2020 election really could flip this. So their chances now, I mean, they've got to make it happen in 2021. As we most know, that almost every midterm election, the White House the party that's in the White House loses some seats in the midterm election. That's happened every election since 1938, with 2 exceptions. Only in 1998 and in 2002 were the only 2 exceptions. So look, I think where we're going here may be two bills. One is a bipartisan bill, and 2 is a go it alone bill. And here's the bipartisan bill that is being batted about right now. There's a group of senators called the G20. It's got people in there like Mitt Romney and Joe Manchin. There's Kirsten Sinema from Arizona. Anyway, this group of senators has already come together, Democrats and Republicans, saying we can agree on about 1.2 trillion of infrastructure spending over the next 8 years, but it would be funded out of something other than income tax increases. So they're saying they could get to that. It'd be much smaller than what Biden wants, but they said we can get to an agreement on that, and they could have a bipartisan bill that would do roads and bridges. Okay, roads and bridges, the traditional infrastructure. And how would they pay for it? They're talking about an increase in the gas tax. The gas tax has not been increased since 1993, and there's a talk about indexing the gas tax for inflation. And see, now Biden doesn't like this because, see, that hurts people who make less than $400,000.
It's also a little bit more regressive.
Yeah, he doesn't like it, but he's willing to talk to them. And they're talking right now. And so we may end up with something bipartisan there to do some roads and bridges that will not involve any tax increase. But that won't satisfy them. That will be part of it. The next thing that would happen would be a go it alone. And on the go it alone, they've got to come up with a version that all 50 Democrats can vote on, that can agree on. And what will that look like? The best guess on this, they've got to get Joe Manchin, and they've got to get some of these other moderate Democrats from purple states to vote for it. And that's going to require things like Joe Manchin has said, okay, corporate income tax can go up from 21, but he won't go to 28. He said he'll go to 25. Well, maybe the corporate income tax rate goes to 25. I think they have enough support to do this 15% minimum tax to sock it to Nike and Amazon, because that only hits big global companies. The prediction I've heard for capital gain is they maybe come up with a compromise where it would go up from 20 to 28.
Manchin, I think, gave a little bit of tacit approval for that as well, I think.
Yeah. I think it's going to happen. 28 plus, now you have to tack on the 3.8 Obamacare tax, so that gets you to 31.8.
By the way, that's also going to be now for people that sell their businesses, where that was an excludable event for the net investment income tax, the Obamacare tax before.
That's right. You used to be able to avoid the 3.8. Now you wouldn't be able to. Yeah. So that's going from 20 to 31.8. That's still hefty. They want to beef up the IRS, and spend some money to make the IRS. Biden wants to give $200 billion to the IRS to go hire 87,000 IRS agents and go after the cheaters. They're really trying to target the cryptocurrency crowd. There's a lot of belief that there's a lot of revenue that's not being reported by crypto people.
I've heard from a lot of people that do it. They're now moving a lot of their crypto to some form of Coinbase offshore, which of course you can't ship your money offshore without disclosing it. It's tax evasion.
That's tax fraud. Biden thinks that'll raise $700 billion of revenue. I don't think it necessarily go that. Don't touch
Don't touch my crypto.
Yeah, a lot of people feel that way. But I think we're in for this increase in capital gain. And as I said, I think it's going to get paired up with the killing stepped up basis. I don't think Biden will ever decouple them. They're not going to get decoupled. I think we're in for a killing of stepped up basis. And as was mentioned by you a little earlier, the estate tax exemption may not get affected this
Where do you want to spend your political capital?
Yeah,
Right.
they want to spend it because if they just leave that one alone and you just wait out 4.5 years, then it goes in half automatically. It doesn't require any action by Congress. So, they may just wait for sunset. And you wake up on January 1, 2026, 4.5 years from now. And that's not far off. If you're like me, you blink your eye and that is here, and all of a sudden, the estate tax exemption now in half. And so I could see that being the compromise here. And I think that, there's a big push from owners from farm states, people who own family farms, family businesses, to say, don't mess with our estate tax exemption. But I always call this the Cinderella thing. That's on midnight, December 31, 2025, Cinderella's coach turns into a pumpkin. Yeah. The stroke of midnight, your exemption's gone in half. Look, I've got a 90-year-old mother. Her estate is growing because she spends nothing. Thank God she's been a wonderful saver, but she's on a course to where her estate is currently below the exemption, but it will be above half of the exemption. Yeah. Okay. And if she keeps on her course, and God willing, she lives a long time, she's going to exceed half the exemption. We're planning right now to lock in that exemption, and we're shifting her assets out of her name. And she's all
clients in Austin that because of a lot of the influx from places like California, their houses are going to be above the exemption because of the inflation.
Oh God, yeah.
Absolutely. People that had a $700,000 house several years ago, that house is now $3.5 million.
Yeah, it's insane. Yeah. And just getting worse. So I don't think that you should sit around on your hands and say, okay, I'll wait and deal with this estate tax exemption being left intact for another 4.5 years. Because while you're waiting, if your assets are growing, and most of my clients, that's what's happening, like my mom, the assets are growing, you're sitting around on a time bomb here because you need to act now.
Let me throw a question at you, because one of the guys, Nick, asked this question: do you think the estate tax exemption is more likely, or the step up? One thing, if they get rid of the ability to have, as an example, defective trust, and even leave the exemption, it will be harder to gift $11.4 million without it being an income taxable event.
Exactly. So I think they're going to go after step up. And I think that the estate tax exemption may stay at 11.7 for now. But and then he's asking about a de minimis threshold, and the de minimis threshold for step up is only $1 million.
Yeah.
It ain't much. And plus they talk about you can avoid paying income tax on the first $500,000 of gain from the sale of your home, but that's an old provision. That's nothing to do with step up. And so the thing here is that they're making sausage when they make these tax acts.
Yeah.
We saw that with the Trump Tax Act, and you never know what they're going to slip into it. And so you made a very good point, Scott. They could say, let's just go after step up. That's where the money is. That's truly where the money is. And let's increase the capital gain tax rate. And while we're at it, let's, in the dark room when no one's looking, let's throw in this provision that kills grantor trusts. Yeah. And no one will talk about it. They'll vote on 1,000.
Don't understand it. I mean,
yeah, they don't understand it. Yeah. They'll vote on a 1,000-page piece of legislation without reading it. They'll say they pass it, and then they'll say, okay, now let's read it and see what we passed. This is how it works. And they'll read it and say, oh my goodness, we killed grantor trust. Oh, you mean that kills ILETs? Oh, we didn't know we were doing, but that's, try to go get that repealed. I mean, that is not so simple.
It could also kill formation of business partnerships. You and I both had a trucking business and we wanted to form a partnership together, and we both contributed our trucks. With the legislation, the way they're talking about, that would be an income taxable event
Exactly.
to fund that new partnership.
Yeah, I think there's going to be a lot of unintended consequences because this kind of stuff passes without it being without a spotlight being shined on it. And that's how they have to do it. They don't want the world to read it. They want to pass it and then let the world read it.
And then politically, it'd be hard to fix it. Remember with Obamacare, it was passed purely partisan.
Yeah.
And then they wanted to fix it with very logical fixes. And the Republicans said, no, it's your problem. You fix it. Yeah. And so if we pass this thing and it has unintended consequences, these could be really, well, we're kind of getting through time. So one of the things I wanted to go to was another point. Knowing that we don't know what's going to happen and knowing that some things can be retroactive or not, maybe you could talk both about some of the planning you're seeing and maybe even a little bit about some safety valves you might be putting in the event of retroactivity.
Yeah, very good point, Scott. No one has a good crystal ball. No one has a great way of reading the tea leaves on this. What I submit to everyone on this call, to all the clients I speak to, is let's get in front of this thing. Let's do proactive planning and not reactive planning. I don't want anyone to wake up on January 1, 2022 with regret and say, oh gosh, it's too late now. I sure wish I had done X. So here's what I'm proposing. There are a lot of planning ideas that you can enter into right now that you would not regret having done them, no matter what happens to the tax law. And I would suggest to you that any kind of use it or lose it planning where you're trying to lock in the $11.7 million exemption, and you engage in what we call squeeze and freeze planning, like I talked about earlier, the family limited partnership and the gifts to the slats and things like that. People who do that, they have not regretted that they've done that. And why do they not regret? It's because we structure it in a way that they can stay in control of their assets. They can continue to have access to their assets for their needs. So they keep control, they keep access, and they retain flexibility. They get a special power appointment in these trusts that allow them to determine who will inherit it down the road. They're not locked in. They like all that. And so there's no remorse. They entered into this and there's no remorse. Now they've put their stuff into a place where it's grandfathered. If the law passes, there's not going to be regret on that. What should single people do? My mom is one of those, and we're doing a grantor trust for her, a defective grantor trust. She's making a gift of her assets to the defective grantor trust with the understanding that she would have she would live off of she'd have to borrow money from the trust in order to pay her living expenses if she runs out of other money outside the trust. There are other techniques, but it's easier for married couples than for single, but for
maybe for some single people, maybe for some income, some form of grats before that's killed, possibly too, for income.
Yeah, a grat is another possibility, and get it in under the wire. Exactly. Yeah. And so there are some tools that are geared for that. What else are people doing? The Roth conversion. I'm seeing a lot of Roth conversions because the expectation that the income tax is going to only go up. Ordinary income tax rates is most assuredly never going to go down in this environment with this.
Well, one of the things real quick what to look at, because even if they don't increase taxes significantly for people over 400,000, when I'm already seeing some of the things looking at the tax brackets, they're compressing some of the tax brackets. So some of our, manager executive type clients may find that the people with no real deductions right now may see themselves pushing up into a slightly higher income tax bracket as well. So I would say when you're doing things like that, beware of Roth conversions. I don't think any of the income taxes are going to be retroactive. That's my personal belief. That's not in legislation. So I think as we approach the fourth quarter of this year, or maybe on any market pullback, it's definitely a time to consider a Roth conversion.
Yeah, and you asked about building in safety valves, and we discussed that with clients. Some are inclined to do, others are not so worried about retroactivity and feel like we'll be okay. But in other words, what some people are doing is saying, I don't want to commit to making these gifts and then later be told I have a surprise gift tax. So what they do is things like they'll they'll sell the assets to a defective grantor trust. They'll carry a note. And then in December 31, when they see that the coast is clear to make the gifts, they can forgive the note as a gift. So it postpones the date of the gift until you feel like the tax landscape. But you don't want to wait till December 31 to act, because then you don't have time to do it. So this gets all the hard part done, and then you pull the trigger on the easy part, on December 31. There's people are doing things like they're drafting trust for a spouse that have that could qualify as a marital deduction trust, and then therefore, if the law passes in a way you don't like, you can elect marital deduction. You have until next year on October 15, really, with extension, to make that a marital deduction election. So it gives you time to assess it. And so there are some safety valve things you can build in if you want to build optionality into the planning. I don't think it's going to be retroactive. I mean,
I believe that now. Yeah.
Even, the capital gain tax rate, for example, I've got a lot of people who are trying to sell businesses right now, and they're nervous about this because there was this Biden position that said it should be effective April 28 of 2021.
That was in his green book, but that's just his thought process, because they don't want to have craziness at the end of the year in terms of people doing tax gain harvesting in December.
And we have never had a retroactive capital gain tax increase in U.S. history.
Yeah.
And Congress is dysfunctional as they are. They tend to not want to disrupt planning. I mean, I think they don't want to take people who have done things thinking the law was A, and then say, hey, surprise, back when you did that, we now made it retroactive and the law was B. I mean, they tend not to want to do that to people. That's really egregious. So I don't think it's going to happen.
Well, it's political, so they want to be reelected again. One thing we haven't talked about, there's two questions in there that we can have. Number one is talking about selling a large home for a gain. I don't know very much for that, if they're already contemplating it, other than maybe gifting part of it and income shifting. But then maybe we could also talk a little bit about charitable planning. They talked about donor advised funds. I'm a huge fan of charitable planning, but one thing on there is I have been reading some stuff recently about people that don't do just direct outright gifts to charity, but using things like CRUTs. You may have some issues in terms of income that you're receiving because of the changes in tax laws as well. That was something I hadn't anticipated until I listened to a Michael Kitsis, I think it was him, or no, it was a Bob Keebler podcast over the weekend. Because I'm just cool. I listen to Bob Keebler on my weekend.
I'm nerdy like that too. You and me both, Scott. Charitable planning is very fascinating in all of this, and it's getting a lot of attention. I'll tell you what, this is the year to make a big gift. If you want to make a large cash gift to a public charity, this is a year where you can give up to 100% of your adjusted gross income. Last year and this year, the only two. And this is also a year where we don't have a PEAS limitation cutback.
Which they're talking about adding back in.
Deductions.
Yeah.
So if you're itemizing your deductions, you can deduct that full gift without any haircut, but they're talking about reinstating the PEAS limitation. So next year, if you made that gift next year, you'd probably lose a lot of that itemized.
For high income taxpayers.
This year you get, itemized deductions. This is the year for big itemized deductions, especially charitable. And I can tell you too, that the IRS is, there are people screaming about the fact that people are parking a lot of wealth in donor advised funds and then not giving it away.
Correct.
So getting their income tax deduction right now. So this week, there's a new bill being introduced in the Senate this week by Senator Angus King and Senator Charles Grassley, saying, if you put money into a donor advised fund, it has to be given away over a 15-year period. You can't park it in there forever.
Oh, mine's grandfathered.
Yeah. But there you go.
Yeah.
So they say you're getting this tax deduction now, and then you're parking the money in a fund that you may not give away for a very long, long time.
Well, to get Warren Buffett to pay his fair share, maybe they should cap the size of private foundations that say like 10 million, 50 million, and have the rest have to go to public charities. That will actually inconvenience some of these billionaires where income tax doesn't and estate tax doesn't. But they want to leave billions of dollars in perpetuity in these private foundations.
Yeah,
that would inconvenience them.
And of course, private foundations do have to give away 5% a year of their assets, and they're talking about increasing that 5% to maybe 10. And but they're also trying to close a loophole there, because private foundations right now can satisfy that by giving it to a donor advised fund. So they're just parking it somewhere and still delaying, and they're going to try to kill that. This bill would try to kill that. So there's a lot happening here to pay attention to in the charitable front. We haven't talked about other stuff. There's SALT limitations, very hot topic. You remember in the Trump Tax Act, he got back at New York and California by saying the income tax itemized deduction for your state income tax and your property tax is going to be capped at $10,000. That made people in New York and California very, very angry, but he was sticking his thumb in his nose on them.
Some Democrats in the richer states, not the people that are much more progressive, like AOC, who thinks everyone should pay their fair share, but some of them saying, I'm not going to vote on any legislation unless you give the SALT. But guess what? They could do the SALT and the Ps and then kind of make everyone a little happy and everyone a little mad at the same time by giving them the SALT, but then phasing it out.
Yeah, SALT is very expensive. To get rid of SALT costs a lot of money. And another one they want to get rid of is this Section 199A pass-through deduction for people who have ownership interest in closely held businesses, like in a pass-through. And boy, that's been fabulous for most of my clients who own, S corps and FLP partnerships. That gets killed too. So, like-kind exchange of real estate. That's on the topic. Yeah, and the proposal is that to limit the gain deferral to $1 million a year. So you can do a like-kind exchange and defer gain up to 1 million, half that if you're single. But if you want to defer more than $1 million, you're out of luck. So the 1031 like-kind exchange is on the chopping block.
And there's not going to be a lot of people really promoting and putting a lot of effort into that area. If the most of a real estate transaction they can have is $1 million, it becomes more of a nuisance.
Yeah,
than something that's really a planning technique, I would think.
Yeah. So you're seeing a push to do the like-kind exchange. You're seeing a push to sell businesses, a push to, and if you sell it on the installment sale, you don't elect installment treatment. You want to go ahead and pay the tax in this year, all at this bracket, and not pay it out over the installments over the time as you collect on if you're carrying a note, you don't want to pay it out over the time. So there's a whole lot going on in the planning world. You could put assets into a CRUT, like you said, that's a really fabulous technique too. A charitable remainder unit trust. I've got a stack. I'm heavy in one position. I want to get out of that. I want to diversify, but I don't want to incur the capital gain tax. So I put it into this charitable remainder trust. Then the trust sells the stock. Nobody pays tax right away. But as it dribbles money back out to me over my lifetime, I'll gradually pay the capital gain tax. So it's a deferral opportunity.
But high income people won't get that benefit, because if you make $2 million a year of earned income, it's going to push you, depending on where the capital gains rates are. That's why these things are really, really complicated and really, really looking at. One thing we talked about 1031s that people forget about is, well, that's just capital gains tax. Well, if you owned a warehouse and you depreciate it, it's not just capital gains tax. It's also recapture of depreciation that historically you could avoid by doing a 1031 exchange.
Boy,
there's a lot of these things.
There's a lot to this
people aren't thinking about.
Yeah.
So let me kind of see if there's any final questions. If you want to take a look at the chat box real quick, if there's any ones we have time to. We only have another 6 minutes, but if there's anyone you think that's big that we didn't hit on, I'd love to hit on those.
So yeah, if you have an existing biz to be sold this year, an FLP, I would say yes, create an FLP, put the business in the FLP before you sell it, transfer the business into a grantor trust, do gifts and sales of the business to a grantor trust, get it out of your estate.
But the appraisal, part of it will be is what is the appraisal at? If the appraisal keeps it well below the exemption, I did that right now. We have a business that last year we got an appraisal for 36 million owned by two brothers. So 18 million each, they had more exemption. We just sold it for a composite value of $150 million. So now we between idiots and slats, we have two clients that are worth combined, these two families, $200 million with zero estate taxes.
That's music to my ears. And
Isn't that awesome?
That is day in and day out what we do.
Yeah.
That's why we're busier than we've ever been doing that. And so we love to have the opportunity to talk about all this stuff, because not everybody understands that opportunity out there exists. And there's people who are reluctant to do it because they think they're going to lose access to their assets or lose control. But you can do it in a way where you retain control and you can retain access. And that's what a lot of people don't understand.
Whether it's FLPs, recapitalization of businesses, all these things, we're already almost halfway through the year, people listening. These things, even with reconciliation under new laws, can possibly start happening again in October, which means we basically have a quarter to talk with these things about our clients. I recommend that you share these things with your clients. in kind of closing, Nick is going to be putting a replay on this out. Marvin said he put together a nice summary of the topics we talked about with his contact information, so you can easily contact him. So look for the replay when this is posted to the FPA Knowledge Circles. You can get that information. Nick will also include some of the articles I've written. One of them has some replays of a radio show and some stuff I've done with Marvin. There'll be a lot of good information. And if you want to follow Marvin's firm on LinkedIn and Twitter, they're there. If you want to follow some of the stuff I write on Twitter, it's at ScottB_CFP. I'll put it in the chat area before we're done. And I'll also be posting this replay when I get it. So there's a lot of good things here. Nothing is guaranteed, but please, please, please keep at least somewhat on top of this for your clients' benefits, for your practice benefits. And hopefully, if you learn some of these things and you really work at it, like I had said before, even if it can't help your bottom line, perhaps it can help your top line by bringing in more revenue as a thought leader in this area. Thank you, Marvin, for getting this done. Thank you, Nick, for setting this up. Everyone, have a wonderful week, and we look forward to having you on the Knowledge Circle for the tax and estate planning next month. Have a great day.
Thank you.